Welcome back to The Explainer. So today we're diving into a massive global financial shift. It's one of those things that starts an ocean away, right? But it could literally end up at your front door. We're going to break down the data, follow the money, and piece together exactly how this giant macroeconomic puzzle fits together. Now, you might be wondering, how on earth could a tiny 15 yen price bump on a simple Tokyo rice ball actually hike up your American mortgage? I know, it sounds like the setup to a weird joke. But seriously, if you pop into a convenience store in Japan, an onigiri, a rice ball, that used to cost 120 yen might now be 135 or 140. It's just a mundane, everyday metric of inflation. But that little price bump, that is actually ground zero for a massive ripple effect that could hit US markets, your 401k, and honestly, the entire global economy. So, here's our roadmap for this explainer. We'll be looking at the Japanese debt bomb, central bank strategy, the yen carry trade, the impact on America, demographics and deficits, and then we'll wrap it all up with a strict 3-scenario global risk assessment report. Let's get to it. All right, Section 1, the Japanese debt bomb. Okay, let's dive right in and establish our baseline threat here. Economists generally start to sweat, maybe even panic a bit when a country's debt to GDP ratio hits around 90%. Basically, that means you owe almost as much as your entire economy produces in a single year. Now, for some context, the United States currently sits at a very high 125%. But Japan is sitting at an absolutely astronomical 260%. Yeah, 260. That makes them the most indebted country in the modern developed world. And this unbelievable debt load, it all stems from this legendary asset bubble back in the 1980s. Things got so completely out of hand that, supposedly, the grounds of the Imperial Palace in Tokyo were worth more than all the real estate in California combined. Crazy, right? Well, when that bubble popped, it triggered a brutal 15-year deflationary spiral. Moving on to Section 2, Central Bank Strategy. So, how does a country even survive that much debt for 3 decades? Well, the answer lies with the Bank of Japan, or the BOJ. To fight off that relentless 15-year deflationary spiral and somehow keep the cost of their massive debt manageable, the central bank deployed this incredibly aggressive 3-step strategy. Step 1, they slashed interest rates to near zero. Honestly, sometimes they even went negative. Step 2, they launched massive quantitative easing, which is basically just printing money. And step 3, this is the most drastic one, they introduced yield curve control. This artificially capped how high bond yields could go. Just to give you an idea of how extreme this intervention was, the central bank essentially bought up their own debt just to keep prices up and yields down. Fast forward to today, the BOJ owns 50% of all Japanese government bonds. And for the 10-year bonds specifically, they own an astonishing 90% of the entire market. 90%. But here's the catch. This is the central bank's ultimate legislative trap, and it's being triggered right now by the sudden return of inflation. Remember that rice ball from earlier? Japan's inflation is back, and their bond yields have hit 2-decade highs. So the central bank is now staring down a literal binary trap. Let's look at option A. If they raise rates to fight inflation, the cost to service their $8.6 trillion debt just absolutely skyrockets. I mean, right now, debt servicing already eats up 25% of the government's entire budget. But wait, on the flip side, we have option B. If they leave rates artificially low while inflation keeps rising, the yen will completely collapse in value, and that sparks a full-blown currency crisis. Which brings us to Section 3, the yen carry trade. Now, this is the global arbitrage mechanism that connects Japan's domestic trap directly to international markets. For years, global institutions ran what was basically a brilliant free money hack. See, because the Bank of Japan kept rates at zero, massive institutions, we're talking pension funds, huge banks, they could borrow Japanese yen for practically nothing, like 0.1%. Then they would just convert that yen into US dollars and go buy US Treasuries that were yielding around 4.5%. That creates a sweet 4.4% profit spread. To put that into perspective, if an institution borrowed $1 billion in yen, they essentially generated $44 million a year in massive low-risk profit. It was literally a Wall Street dream come true. As long as Japanese rates stayed at zero, the math worked out beautifully. But, and this is a huge but, here's where the urgency really kicks in. We call it the unwind. With Japanese 10-year and 30-year yields now hitting 2-decade highs and climbing over 3%, that free money trade, it's completely dead. Once you factor in higher borrowing costs, currency conversion, and hedging fees, the whole profit spread just vanishes. So, what do all these global institutions do now? Well, they're being forced to rapidly repatriate their cash. They have to unwind their investments, sell off their US assets, convert those dollars back to yen, and pay down their massive debts.
And that leads us right into Section 4, Impact on America.
All right, let's connect the dots directly back to you. Why is this foreign central bank maneuver an immediate threat to us here in the US economy? Well, Japan isn't just some isolated economy doing its own thing. They are the single largest foreign holder of United States government debt. They hold up to $1.2 trillion worth of US Treasuries. 1.2 trillion? So if Japanese institutions are forced to rapidly unwind their trades and stop buying, or worse, if they start mass selling their US Treasuries, it creates this massive downward selling pressure. And here's the rule. When bond prices go down, US bond yields are artificially forced upward. So the crucial point here is that when US Treasury yields go up, borrowing costs across all of America go up right along with them. Let's look at the tangible, real-world cost of this. If those rising bond yields push American mortgage rates up by even just 1% on a $400,000 home, that adds roughly $250 a month to your housing payment, just like that. And if we expand that single data point out over the life of a typical 30-year mortgage, you are looking at over $90,000 in extra interest paid by everyday Americans. 90 grand, all because inflation forced the hand of the Bank of Japan. And it doesn't even stop at housing. Higher interest rates severely hurt U.S. stock valuations too. When baseline interest rates rise, the present value of a company's future earnings shrinks, meaning even highly profitable U.S. companies could see their stock prices drop.
Okay, let's look at Section 5, Demographics and Deficits.
Because there are some severe macroeconomic accelerants that are making this bad situation drastically worse. Japan is facing a total population collapse. Let's look at the numbers. Back in 2010, they had 128 million people. Today, it's already under 122 million. And by the year 2100, projections showed their population plummeting to just 75 million. In fact, last year, Japan recorded the fewest births since they started tracking them way back in 1899. Now, why does this matter for the debt? Well, an aging, shrinking population means fewer workers, right? And fewer workers mean less tax revenue and less GDP growth. Mathematically, it just makes servicing that massive 260% debt exponentially harder, even if the debt itself just stayed completely flat.
And unfortunately, this is a compounding global problem. There's a great quote from our sources that hits the nail on the head. Every major economy is competing for bond buyers at the same time. Think about it. The US, the UK, France, Italy, they're all running massive deficits with debt to GDP ratios well over 100%. We literally have more government debt in the world right now than at any point in human history. The US desperately needs buyers for its debt. So if Japanese institutions, who historically have been our biggest buyers, suddenly step away from the bond market, it creates a highly, highly dangerous void.
Which finally brings us to Section 6, Global Risk Assessment. So what does this all mean? Where does this actually lead us? Drawing directly on our sources, let's walk through 3 strict potential outcomes in a sort of structured risk assessment report. First up, Scenario 1, the soft landing. Now, this is the most probable outcome. In this scenario, the Bank of Japan manages to execute a slow, highly controlled rate increase. Remember, the central bank is incredibly experienced. They've been managing this specific deflation and debt problem for 30 years now. If they can meticulously engineer their legislative and monetary response, allowing those yields to rise slowly, global markets will actually have time to adjust. And ultimately, the global financial system adapts and stabilizes without any major panic. But then we have Scenario 2, which is much more volatile, the carry trade crash. In this scenario, Japanese yields spike way faster than anyone expects, maybe shooting up to 4 or 5%. This triggers a completely chaotic, rapid mass sell-off of US Treasuries as all those institutions rush to unwind their positions. And of course, selling triggers more selling in this vicious chain reaction. Our sources actually note a pretty ominous preview of this unwind back in April of 2025. Japanese investors dumped $20 billion in foreign bonds in a matter of mere weeks, causing real market dips. This kind of rapid crash scenario, it's most likely to be triggered by sudden geopolitical shocks to the system. Things like escalations in Taiwan or airstrikes in the Middle East. Those are the kinds of shocks that instantly force investors to just liquidate their assets. Finally, we have to look at Scenario 3, a full fiscal crisis. This is the absolute worst-case macroeconomic scenario. Here, the central bank's strategy completely fails. The cost to service that massive debt becomes mathematically unmanageable. To avoid an outright default, the Bank of Japan is forced to just begin unchecked money printing just to pay their obligations. And that severely devalues the yen and sparks catastrophic hyperinflation. Look, whether this plays out slowly through a soft landing or fast through a market crash, the downstream effects are going to hit you directly. We're talking more expensive housing, higher interest rates, and major shifts in your stock portfolios. So I'm going to leave you with this final provocative thought to take away from today's explainer. Is the era of cheap American borrowing, heavily subsidized by foreign investors, officially coming to an end? The data strongly suggest we are entering a brand new macroeconomic reality, and it's absolutely vital we continue to track these shifts. Keep learning, keep analyzing, and thanks for joining me on The Explainer.